Yeah. So conventional loan's 80-20. If it loses value, that's my money that is getting hurt. Does the bank care? No. They're still getting their first 80. Theoretically, it could drop all the way down to 80%, and they still don't care. All right? This is kind of the answer, once again, we talked about the other day, why banks also don't necessarily escrow if you've got a conventional loan, because the theory is before you'd let the house go to a tax lien sale, you'd drop the price down enough to pay everything off and walk away because you got enough equity. Sure, it would suck that you lost some of your equity, but you certainly wouldn't get your credit dinged and go through the embarrassment of all of that. So that's why most lenders on a conventional loan don't necessarily require you to escrow your payments. Once you start getting above this number, other things kick in. Let's change the scenario. Suppose now I have 100% loan to value. How much equity do I have? None. Now the value drops a little bit because of all the bank-owned homes or other things, whatever, in the neighborhood. My value drops. Whose money is getting hit now? The bank's money. Do you think they care now? Oh, yeah, they do. Matter of fact, they care so much that if you get a loan above 80%, they're going to force you to buy them an insurance policy that protects them that is called private mortgage insurance, PMI. This is where PMI comes in and why it's there. This is the exact reason. If they loaned you 100, they gave you more than they really wanted to, but they were helping you out, but yet there's still a big risk that they could lose money because the value drops. So they're going to say, we'll loan you 100, but we want you to buy us an insurance policy that will cover us in case the value goes down and you have to sell and we lose money. We're going to hit the insurance company. That's what PMI is. It's private mortgage insurance. It's nothing but an insurance policy from some insurer to your lender that you get to pay for. All right? Now, when you start out with 100%, every time you make a payment, remember on the amortized loan, every payment has a little bit of principal. So your percentage drops, doesn't it? Because now your loan, that example we had the other day, borrowed 100 grand, it's the first payment, I only owed 99,750. So now I've got less than 100. And every time I make a payment, I keep increasing that equity because my loan amount is going down. At some point, I will reach that 80% loan to value again. PMI comes off. Once you get that ratio of 80% loan to value, PMI comes off, or it's supposed to. All right? Sometimes you have to give the bank a little nudge to remind them, hey, you got to take that insurance policy out, okay? There are laws that say it's supposed to. So if I start out at 100% loan to value, how can I get an 80% loan to value? There are two ways. How can I get the ratio of an 80% loan to value if I start with 100% loan to value? One of the things I could do is what? I could pay my loan down to here. Now the ratio, the value is the same. Loan is less. I have an 80% loan to value. Typically, that's called hard equity because you've actually went in and paid money. I hit a lottery, paid 20 grand down on my house payment, and boop, dropped down. What's the other way I could do? I could keep the loan the same and raise the value and still get that 80% loan to value. How do you do that? You get it reappraised, all right? You would get it reappraised. A lot of times this is called soft equity. Soft equity is harder to generate because you have to convince the bank the house they loaned on at 100 grand is now worth 125. I was involved in one where the bank required this guy, and he ended up getting 3 separate appraisals. You know, they got one, and they're like, yeah, sure, whatever. So he got a second one. They're like, okay, we'd like a third verification. He paid for 3 appraisals, and it all came back in that frame. You know, hey, it's hard to believe a house jumps that much in 2 or 3 or 4 years.
Even if you bought a remodel?
Yeah.
Yeah.
It was just because everyone else started bigger houses.
Yeah. Well, is it crappy? I mean, they're just trying to protect their own self. I mean, if you bought a house for 100 and you come to me in a year or 2 years and go, it's now worth 125, I'm going to make you prove that.
Yeah, we jumped 50,000 in 3 years.
Yeah, jumping 50 grand in 3 years is a big increase.
Yeah.
So the bank are going to say, you know, we want proof because we certainly don't want to get screwed in this deal. Okay? So you can generate that by either paying the loan off. The reason that's called hard equity is because we're not arguing over the value. We've already determined the value, and they had an appraisal at 100 grand. You paid 20 on it. You now got an 80-20. That's hard. The soft equity is you still owe 100, but now you've convinced them that the value is now worth 125. That's still 80% loan to value. So anytime you generate anywhere between that 20 to 22% equity, PMI is supposed to drop off. All right? So I remember that number, somewhere between 20 to 22%. PMI will drop off. Now, we're going to talk about some of the governmental loans. I want to talk about a new thing that's just recently happened. Well, recently within the last year. FHA. You're going to find out here in a minute, FHA has PMI on it. They passed a rule that says PMI will never come off no matter what loan to value you create. If you get a FHA loan, first of all, look, October of last year. Yeah. First of all, FHA, I'll give you a sneak peek, is 96.5% loan. All right? It's designed to help people not have to have as much money down. So it's a 96.5% loan. You pay PMI on that because you're above that 80% conventional threshold. So they charge you PMI. But PMI never comes off on an FHA loan. So let me ask you a question. This is the Columbo question for the day. Is it a good thing or a bad thing that that PMI never comes off? Okay, I would not answer quickly like that because you know it's not going to be that answer. Is it a good or a bad thing for either person?
I would say no. It protects you both ways.
All right, it took me a while to think through this.
Does it protect all of it? Like,
Okay, you're getting too esoteric.
The homeowner. We know
So if the homeowner generates and pays off enough of this loan, he's down to a 70% loan to value. He's still paying PMI on an FHA loan under the current laws.
you're paying the protection of the bank.
But he's got 30% equity.
then you go with finance from someone else that you mentioned.
The answer is, it is a good thing they kept PMI on. Because what does FHA, I just told you, designed to help? People that need help, right? So what was going on prior to October of last year, people were getting FHA loans, in essence taking the money out of the government's piggy bank and keeping it for 30 years. That doesn't really help the pay it forward kind of syndrome. So what FHA did is come with this idea that I think is actually genius. When you get to 80%, they're still going to make you pay that other $125, $200 a month, whatever the premium is. They're going to make you feel the pain to the point of where you refinance the loan. And what's a refinance? It's a sale with a repurchase. So what happens to the FHA's money? It gets put back into the coffer by this conventional lender that now says, oh, Raymond's 70% loan to value. Yeah, we'll give you that 3.75 interest rate with no PMI, none of that, no escrow because you got a 70%. Let's pay off your FHA loan and get a new one with Fifth Third. Now, my kids have money in their FHA bank, finger quotes, because I put it back in. So the reality is them keeping that PMI on there is actually a very smart thing because it will force you at some point to refinance unless you're dumb enough to keep paying that $100 to $200 a month PMI. And probably what's going to happen is you're going to get a better interest rate too. So you're going to take your FHA house payment of $1,700, refinance it, lose PMI, get a better interest rate, and now drop it down to $1,200, say $500 a month. Wouldn't you guys do that? Yeah. And what happens is you put the money back in the FHA. Now your children have money in the FHA. They can go buy a house or some other person. So that's what they did. That enacted like last August or October of last year. Now, remember, it doesn't affect you when you first get your loan because you don't have 80% anyway. It's going to take you a year or two or 4 or 5 to get that 80%. So it doesn't really matter to you if you've got an FHA loan until it matters, and then you will refinance.
So, is it all new loans going forward, or is it?
No, it's a good question. It's only the loans that were written after October of last year. Shoot, it may have, time goes by. It may have been 2015. May have been October of 2015. I can't remember. All I know is currently it doesn't come off. All right? So let's talk a little bit about FHA loans. FHA is the Federal Housing Administration, which is operated under HUD, the Department of Housing and Urban Development. The first thing you need to understand is FHA does not loan money. We say this all the time. I got an FHA loan. No, you didn't. Technically, FHA doesn't loan money. VA doesn't loan money. Farmer Mac, we're going to get to, doesn't loan money. SBA, I know it's not a housing program, but same concept, don't loan money. None of these people loan money. It's an FHA insured loan, meaning the bank still loans the money, but FHA has said, oh, Mr. Bank, loan the money to Raymond, and if he screws up, we'll guarantee that he's okay. All right? So it's an FHA insured loan. FHA doesn't make it. I still got my loan from Nat City. They're an FHA lender. So you still go to Nat City, you still fill out the application there, you still got to pass their qualification, then you pass FHA's qualification, and then Nat City loans you the money. Think of FHA almost like a cosigner. They're saying, okay, Nat City, Raymond's a good guy, we've checked him out, you've checked him out, loan him the money, and if something happens, we will screw up. If he screws up, we'll pay it. Which reminds me, I want to visit one thing yesterday just so you guys have information. I don't know if it's necessarily on the exam, but I want you to know this. Remember we told you after foreclosure, banks go to sheriff's sale?
Yes.
They sell their house. If the house doesn't sell at the sheriff's sale, the bank then takes the house back to their bank, right? But before they walk into the bank, they ask themselves a question. The loan that Raymond just got foreclosed on, Was it a FHA loan? If it is, FHA promises to make the bank whole, right? You see this circle I'm trying to complete? So what the bank does is they turn to FHA and go, hey, Raymond, who got foreclosed on, lost his house, but you insured it because it's an FHA insurance. We want to be made whole, so the FHA gives the bank their money. What does the bank do? Well, you paid for the house. You might as well take it. They give it back to FHA, and it becomes a HUD home. That's where HUD comes from. Those HUD homes you see that are listed, they are houses that whoever was foreclosed on was an FHA loan, and the government had to pay off, and now they have the home. If the bank gets to the front door and goes, oh crap, we made this loan, this is our loan, it now becomes an REO bank property, bank owned. REO stands for real estate owned. That's a bank owned property. So the big difference between a HUD home and an REO home is what loan did the person have that got foreclosed on to get it to that point. Up to there, they're all the same.
Would the bank go that route first or go share?
No, it's all the same. It's right up until the very end. They still go through the foreclosure because it's the banks. The question is, would they do it early? No, because the bank still has to get their money. Remember, the bank loaned the money. So the bank wants their money. They go to share sale. If it gets sold, then the bank gets hold. The insurance company, i.e. FHA insured, only comes into play if they say we've tried to go to foreclosure, we've tried to share sale, none of it works. Now we get our money back by going to FHA and going, you backed Raymond on that deal, he went south, we tried to do the share sale, it didn't work. I want you to give me the money. The government gives Nat City the money. Nat City gives the government the house, and then the government puts it up as a HUD home for sale. So the only difference is right when they get back to the front door of the bank and they got their house under their arm, they ask themselves a question. Is this an FHA loan? If it is, it's going to go to become a HUD house. If it's our loan, we made the mistake, then we got to put it in our portfolio and it becomes a bank-owned home that you see out. So when you see homes for sale, one says a HUD home and one says bank-owned, you know the person that foreclosed on it was an FHA loan if it was a HUD home, probably a conventional loan on a bank-owned home. All right? So that's how that full circle comes around with that. Going to change audio.